Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. Happy New Year to you. As we're talking about New Year's, can making financial New Year's resolutions or goals, can they improve your economic outlook? There was a research survey from Fidelity that suggests the simple act of making a resolution may have a transformative effect, but they continue saying you must keep those intentions going beyond January and then turn them into lifelong habits. So, Luke, Art, to accomplish this with your clients, do you set specific financial goals and realistic milestones, not just resolutions?
Yes, we do. Now, every client is a little bit different. We have some clients where we're setting a savings goal, right? How much are you going to save for the year? What account are you going to save it in? You know, in other clients, it's, okay, how much money are we going to spend this year? How much are we going to take out each month? How much does your portfolio need to generate in income? So New Year's resolutions from a financial perspective make a lot of sense. But from my weight loss perspective, it never works.
What?
But when you can put math and numbers to it and run it through our softwares, it makes a big, big difference. Because if you do it every year, you know, one of the tips I always have for people who are still saving is increase your 401k. You know, do it 1 or 2% every year, and pretty soon you're saving a significant amount of money and you don't notice it. So right now, this month, if you're still contributing to something, contribute a little bit more. And then do it again next year and just keep stacking your contributions. It'll make a lot of sense in the long run. And that's some of the goals we write down for our clients is how do we get to where we need to be and what number do we need to be at?
Mm-hmm. Yeah, so what Luke is basically saying there is when you're trying to save more money, it's always hard to save more. You know, we always know that because there's always something pulling on us to spend. And they're usually really good things like a golf cart, right? You know, those kind of things that are always there, right? So we're always going to have those things that pull on us that we have to do. However, if you're wise and you get a 3% raise, 4% raise, 5% raise, and you take 1% of that and apply it to your 401k, if you're doing 6% because that's what the company match was, or 7 or 8, well, now do 9, and then you do 10, and then over time it might take you 10 years, but over time you'll be up to the legal maximum amount that you can contribute and be able to get a deduction for it. So when you get up to those kind of levels where you're doing 18, 19, 20%, all of a sudden your 401k starts to accumulate very rapidly and you're getting a great write-off. And if you know, as a person that works in the field force, if you're getting W-2 income, there are no other write-offs other than maybe your mortgage. And with the deduction today being as high as it is, usually you don't have any other write-offs. So that's a good way to have a legal write-off, help lower that income, and be able to have a good forced long-term savings.
You know, in that same survey from Fidelity, it said that 71% of the respondents in that survey said that they were able to stick to their 2021 financial resolutions and goals. That's up from 58% in 2020. So did you see that yourself, Art? Did you see a lot of people that set those goals at the beginning of the year really stick to it?
Yeah, I mean, the hard thing is about financial goals is taking the time to do it.
Yeah.
That's the hard part. So if you take the time to do it, our clients are always very good and very consistent about it. And then it's usually something simple, like you go into your 401k and you make a change of the percentage. You know, it's money you're not really seeing because it comes out of your paycheck first. So it's easy to stay with that goal because you don't have to take money that comes into your bank account and then shift it to a separate bank account or not touch it. Typically, we're worse there at keeping those type of goals because you see the money, then you want to spend the money. So if you do it with your 401k or your employer platform, it's always the easiest way for long-term savings.
Do you see that, you know, like this time of the year, everybody goes to the gym and they set those resolutions. I'm going to lose weight. I'm going to start eating healthy.
I'm laughing.
Luke, you're going to the gym, aren't you?
No, but I did get some of those Bowflex dumbbells, so they don't take up much space.
Nice.
And you just click in, you know, what you want. And you have 2 dumbbells that's equivalent of 20. So
nice. That's way better.
But continue, Owens.
And how many times have you stubbed your toe because they've been sitting in the same place for?
Well, they're in the garage, so I've only used them once, so I haven't stubbed my toe. I just look at them. They're pretty.
Just look at them.
I got a great boat.
Well, you said it was going to start now. So you said the diet wasn't going to be through the holidays. It's going to start now.
It's going to start now. It's usually the first Monday after the New Year, so it's going to start next week, next Monday.
Right. Okay, well, good luck. We're all rooting for you.
That's the third week.
That's the third week. Well, you know,
come on. Tomorrow we have the World Championship game.
Yeah.
So
I mean, we've got.
Come on,
got
Luke. That is the time to start. Now, you've already delayed 10 days. Come on, stop it.
Yeah. Are we trying to peer pressure him into
Yes.
not losing weight?
Sorry, guys. I told you my New Year's resolutions don't work when it comes to weight loss. They work when it comes to math and savings.
Luke, do you see that, though? Do you see that, like, this time of the year, your phone's ringing a little bit more because people want to get financially fit as well?
I think so. Yeah, people want to get financially fit, and they want to realize what they didn't do last year, right? And that it's hard to quantify that without knowing or asking a professional. But we have people calling in and say, "Gosh, I wish I would have done this and this last year. What would my portfolio look like if I did that?" And we can run that model. We can go back in time and say, if you would have done this, this is what would have happened. But the past is the past, right? So now let's focus on this year, the next 5, 10, 20 years, however long you have to save for retirement, or however long your retirement is, right? Let's not run out of money either. So there's a lot of different things that happen at the beginning of the year. A lot of times it's regret, to be honest.
Yeah, and one of the things we can do, so one of the other equations of not saving money, we have a lot of clients that are spending money. So one of the things that we're always doing with our retirement planning side is, now that inflation is kicking up, this is looking a little more systemic. At first when inflation started kicking up, it was all supply chain interruptions, and this is probably a very short-term thing. Well, we are seeing now that it's going to linger for a little bit longer than some of the experts thought initially. So how much are we building into our model? So inflation is a big part of how long the money lasts, and making sure that you have enough growth in that portfolio that as things get more expensive, you can increase that income to keep pace. So inflation is a big deal. So making sure that you have enough money set aside that as you do those income withdrawals. And a simple thing like this, Mark, if you're taking $10,000 a month for retirement income, in 10 years from now at normal inflation, not at our current inflation of about 3%, you're going to need about $13,000 a month to feel like 10, because everything has gone up about 30%. So the cost of cars, the cost of everything, whether you're walking to the grocery store or filling up your tank, everything has gone up in that period of time. If it stays at 6 or 7%, that could happen in just 5 years.
Right. And something else we always see at the beginning of the year are strategists, economists giving you their predictions of the stock market. Well, let's look at last year. So last year, Barron's asked 10 strategists what their estimates were of the S&P 500. They were in between 3,800 and 4,400. The S&P ended at 4,785. So all of those strategists who get paid to predict what the stock market is going to be were wrong.
Very wrong.
So your investments should match your goals, should match your long-term goals, your short-term goals, not the short-term fluctuations of the market. That's very important as you look out. You're going to see estimates from every big bank, every big company. Somebody's going to throw a dart, put it on the wall, and say, this is what we think the S&P is going to do.
Yep.
Nobody has any real clue when it comes to the exact amount of what's going to happen. All we know are what the earnings of companies are, what the good companies are, what the bad companies are, what interest rates could do to companies, right? What the increase of oil, all of those factors factor into it, but nobody could predict COVID.
Yeah.
Right. There's a lot of things that are just out there that you don't know that are going to happen. So make sure your goals and your investments match each other.
321-425-8550. Always online at artofmoneyradio.com. And we've been talking a lot this weekend about rolling into 2022. And at USA Today, there was an article that says that this may not be the best year to retire. There are 3 points that could cause some to reconsider a 2022 retirement. And that includes the pandemic, inflation, and stability. Do you agree, Luke McCarty?
I agree. It is a concern with some of our clients who are getting ready to retire. I think inflation is the one of those three that people are the most worried about, because when you see gas prices almost double, when you see grocery store prices up 6-7%, and then overall inflation at 6-ish, right? That's quite a bit. It's going to be hard to look at your portfolio and say, hey, if inflation stays at 6% every year, right, I'm probably in trouble. Now, we don't believe inflation will stay at 6%. But I think that's where most people have the most concern is, for the first time in probably, 20, 30 years, we're actually feeling inflation, right? Historically, it's 2 to 3%. Well, this year it's over 6%. So when you think about withdrawing money from a portfolio and you see those numbers and you see the prices of all the things you're buying, it's very nerve-wracking for some. But if you're a client here at McPherson Financial Group, right, we create a financial plan. We run these scenarios. What if inflation stays like this for several years? Does your portfolio work? What if we go back to the historical average of inflation? right? What if the pandemic keeps going on and, whatever it may be, the federal government keeps printing money and taxes go up, right? We can run all of these scenarios to help ease your mind, help you make a educated decision.
Yeah, and we can forecast it out 20 years from now, 25 years from now, 30 years from now, and make assumptions and show how those assumptions affects the portfolio. So that is a real big deal. So that way someone thinks, well, I can't sustain this kind of inflation. I'm going to run out of money in the next 10 years. Well, that may not be true. And we can show that. So we can demonstrate exactly how this is going to affect them. And what is normally true is this too shall pass. COVID shall pass eventually. I don't know how long it'll take, but, these kind of things will ebb and flow. And then, historical averages will kind of be the norm again. But it just takes a while for sometimes those things to settle through. So it's just going through the valleys and the hilltops and just making sure that your portfolio is acting the way we need to for long-term gain.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.